What it is, it's your boy Jeremy Cash live and direct on the Pipology channel, man. It's about to go down today, man. You want to tell them what we talking about today, man?
We talking about the divergence.
You want to tell them what we talking about?
What we doing? We live?
You know Loso always lost.
Oh.
We live, baby. We all the way live, baby.
We live, baby.
Yo, I didn't know we was filming, man. Hey, yo, what's goody, man? What's goody, man? Hey, y'all know we back, man. Y'all know we doing some major stuff right now, man. But let me get this out real quick. First, follow your boy Loso06, Facebook Lo Sanders, right? We're gonna be talking about some dope stuff today, man. Excuse my alarm, my bad. But yo, I'm gonna pass the mic before I mess this up because I didn't know we was recording. Anyway.
What up, man? It's your boy Bobby Will, man. Y'all back with us on Pipology TV. What's poppin'? Hey, man, y'all can follow your boy on IG at I am Bobby Will. That link will be posted down below. Y'all also know about Cash Flow and Chill, second YouTube channel. Check that out if you ain't already on there, man. We dropping gems on there as well. Today, we are going to be covering divergence, okay? We know we kind of jumped into it already with the NBA 2.0 strategy. We had a lot of questions, we had a lot of comments of people wanting to know more about divergence and how to trade with it. We're using one specific indicator for ours, which is the 14-period RSI, but we're going to show y'all how to do it on multiple different indicators and across multiple different pairs. You know what I'm saying? Have multiple confluences because there are different types of divergence. There's weak divergence, strong divergence. We're going to cover all of that. Lace y'all with the whole game so y'all going to have everything that y'all need to know to be able to trade with divergence. Let's get it. Welcome back to Pipology TV. What's poppin', family? We about to do a quick and dirty rundown of divergence and how to trade divergence across multiple time frames using different indicators / oscillators. My personal favorite indicator to use for divergence is the RSI, but you know, some people like to use Stochastic, some people use, you know, MACD, etc., etc. For this example, for this video, we're going to talk about divergence across multiple time frames, and we're going to use the stochastic, and we're going to use the RSI. So we got a 14-period RSI, and then we got the overbought line is at the 75 and 25 level. If you guys are familiar with Jeremy's NBA strategy, you guys already know about the 75 and 25 levels. But if I go ahead and go into my indicator list real quick, if you guys want to know how to get those settings, you just go in here to your levels. You mark a level at the 25, a level at the 75. In your description, you put oversold, and in the other description, you put overbought. All right, so that's it for the RSI. For the stochastic, we just got the basic out of the box settings on the stochastic. The K period is a 5, the D period is a 3, and the other, the slowing is a 3. And we didn't mark any levels on that one, so it's just the normal 80 and 20 levels that you get out the box with the stochastic. All right, we got some more videos we'll get into later about using the stochastic for long-term, spotting long-term trends, but we'll get into that in another video. For now, we're just gonna talk about the divergence. Okay, so what is divergence? What is divergence? Divergence is when you have the indicator reacting differently than your price. So you'll see price moving in one direction and you'll see an indicator moving in another direction. Okay, for example, you may see price forming a series of higher highs while your indicator is forming lower lows. Now, one thing I wanted to give you guys, this is a quick cheat code that'll help you be able to spot divergence a little easier, in my opinion. And what I'm going to do is I'm going to convert our bar chart right here to a line chart. All right. So we're going to convert this to a line chart. So now what we're seeing is the actual highs. So this gives us a better view of, hey, here's a high right here. Here's a low right here. Here's a low right here. Here's a high right here. Right. And this just so happens to be one example of divergence on our RSI. So right here, you see that right at the 25 level right here, okay, we had the RSI gave us, let's go in here real quick. The RSI gave us a high and then a higher high, okay. The price gave us a high and then a higher high, okay.
This is price. Price gave us a high and then a higher high. And then look at what's happening on RSI. Right at the 75 level. Oops, I didn't mean to draw that line. Let's get the trend line. Right at the 75 level, we have price form a high and then a lower high. Okay. Now, once we have this drawn, we can go ahead and jump back over to our candlesticks. So we'll convert this back to a candlestick chart. All right. So essentially, you know when the divergence hits, when this candle goes. You won't really know that it's divergence until this top is formed. This top won't be formed until this candle starts to go red. Okay. So once you see that candle goes red, and you know you can wait for it to close, and it'll close. Once it closes bearish, then you know you have divergence, and that would be your opportunity to enter into this trade. Now this has to be a pretty small scalp when you're trading on this lower time frame. So you could potentially enter the trade here, and you know you're scalping it, you know, so you catch a good, you know, probably 7 or 8 pips on that move. You know what I'm saying? Not a whole lot, but just a quick little scalp, you know. But as you can see, the market does the same thing over here. The market then forms another, okay, RSI forms a lower high here, okay. Market forms another, grab that real quick. Market forms, price forms another high right here, right? And we can go back to our line tools just to draw it a little cleaner, okay? So now we've got another case of divergence here, again, off the 75 level. We're typically looking for this to occur at 70 or higher. 75 level is usually really good for spotting a divergence. So we got a divergence happen here. Again, so on this one, again, you're not going to know that the divergence hit until you see this candle goes red. That's when you see the peak start forming. When you see this candle starts to go below this candle, that's a good indication that the divergence is going to be confirmed, and that's a good opportunity to go ahead and enter the trade. So you could enter the trade right about here. And again, these are quick scalps because we're trading a 5-minute time frame. This trade was good for about 16 pips, and you would have got a sniper entry on that one for a 16 pip trade. All right, and that is off of our RSI. Now let's look and see what we have going on the stochastic. Okay, so on the stochastic, you're gonna see, if you look at the red lines right here, or you can use a green line, either way. On the stochastic, you see a similar thing going on here. From this red line, you're going to see price formed a high and then price formed a low right there on the stochastic. Okay, I mean a high and a lower high. And then the same thing was going on here. Price formed a high and then a higher high. Okay, so you got divergence right here on the stochastic. Okay, same thing over here. You got price formed a high and then price formed a lower high slightly. Okay. And you got the same thing going on with price. Price formed a high and formed a higher high. So you got high, higher high, high, lower high. That's a divergence. So for this one with the stochastic actually makes it a little bit easier for the entry, because when you seen that the green line crossed the red line on the stochastic and it's at the 80 level, this was a great indication to go ahead and enter the trade. And this actually happened a lot earlier. So you actually got the crossover probably right as this candle was starting to open up in the red is when you would have gotten that crossover. So you got a little bit of an earlier entry on that specific trade by using the stochastic. So that is essentially how you can scalp the lower time frames using divergence. Okay. Now we can do the same thing on a higher time frame, such as the M15. So let's go to the M15. All right, so we go in here to the M15, and we're just looking for areas where our indicator and our price action do not agree. Okay, so we're looking for the indicator to have a high and a lower high. Okay, let's pull up the line charts, makes it a little bit easier to see. Here we go. Here's an example right here. So we got price goes from this high right here, okay, comes down and then forms a higher high. Okay, at the same time, our RSI forms a high and then a lower high. You see that? We're generally looking for this at the 70 level or above. This is a great trade. And you'll notice that on the higher time frames, you're typically going to see bigger pip movements. You're going to see stronger divergence with bigger pip movements, okay? So let's go ahead and pull this back to our price action chart real quick. Again, once we start seeing this right here, when you start to see this candle go below this candle right here, then that's a good sign for you to go ahead and enter the trade. So we could have entered right about here, and this trade was good for about 30 pips. You know, if you were more conservative and you waited for the candle to close, you would have missed most of the move, but you still could have got a quick scalp for about 15 to 20 pips on that move right there, okay? And again, we have the same thing going on here. It's a little bit more difficult to see the divergence here on the stochastic, but you can see that the stochastic was going down as well. And then once you got your crossover right there on the stochastic, you can enter the trade, okay? So again, I like to use the RSI because the RSI is a little bit cleaner. It's easier to see for me on the RSI, but you can use the stochastic as well. You know, you're going to have other opportunities that you see on the stochastic that you may not see on the RSI, and vice versa. So if you want to use multiple indicators, then you can use multiple and just look for the divergences that way. Okay, so that's looking at it on the M15. Let's jump up to the M30. Okay, so on the M30, we're just looking for, let's go to the line graphs, makes it a little easier to see. We're looking for an area where our indicator and our price do not agree. Okay, typically looking for it to happen around the 75 level. Okay, here's one right here on the M30. All right, so we got price forms a high and then a higher high. Okay, while we have our RSI is forming a high and then a lower high. Okay, so let's see what's going on here. All right, so at this point, we're going to go ahead and pull this chart back out. This trade right here on the divergence, this would have been this was a losing trade. Okay, so not all of these, you're not going to have 100% accuracy with this strategy. You're going to have trades that do not go your way. Okay, this trade right here, this candle never closed beneath this candle, so that was one indication that there wasn't really a good entry for this trade. But if you had gotten aggressive on this one and went ahead and entered on this candle, you probably could have caught a few pips, you know, probably a good maybe 10 to 15 pips if you traded it conservatively. But more than likely, if you got in late on this trade, like down here, you know, this was not really a good trade. You know, you probably could have got a few pips and got away with it. But the market quickly went in the other direction, strong in the other direction. Okay, so it's not 100%. You got to pick your pairs and pick your time frames. Typically, I don't really use the M30 a lot. My favorite time frames are going to be the M5, M15, and the H1. I typically don't really trade the M30 a lot. So if you look at this same thing on the H1, we're looking for a place where the price and our indicators do not agree, and we're looking for it to happen at around the 25 or the 75 level. Okay, and here we go right here. Okay, we got the market is forming, let's pull this out right here so we can see it a little bit better. We have the market is forming a high right here. Okay, market forms a high right here. Oops, this thing is getting hard to draw with. Market forms a high right here, and then a higher high right here. So we got a high and then a higher high. Meanwhile, on our RSI, we got the high, okay, and we got a lower high right here. So we got highs and higher highs, highs and lower highs. Boom, H1 time frame. So let's go back to the bars. Okay, look, when this one starts to go beneath this candle right here, okay, so you saw that occurring. So you got this candle start to drift beneath this candle right here. So you could have entered the trade right about here. If you're being more conservative, you would have entered the trade here. Okay, you're gonna get a little bit of drawdown here, about 10 pips worth of drawdown, but then this trade goes for a good 28 pips. Okay, this trade moved the market for about 28 pips. Okay, so that was a really good trading opportunity on the H1 time frame. Okay, you can take this up to the H4. I don't really trade it that high, and the only reason why is because the opportunities are going to be very few and far between for good signals on the H4. I typically like to do this on the H1, and you're going to get good signals on the H1 probably about once, maybe twice a week, depending on how many pairs you're trading. You could get a lot more. You could potentially get a signal every day, depending on how many pairs you're trading. And then for the M15, you'll probably get those signals easily once a day. Same thing on the M5, easily once a day. And sometimes you'll see that those are setups for much larger moves. So definitely, you want to look at that really closely. I actually think I see one right here on the H4. We can go ahead and point out since we're already here. So we got price forming a low and a lower low, right? You see that? So price formed a low and then a lower low. At the same time, on the RSI, our RSI from the 25 level is forming a low and then a higher low. You see? You got a low and then a lower low. RSI forms a low and then a higher low. And then as soon as you see that, you go back to our bar charts real quick. As soon as you see this candle going above this candle right here, you see this one going above this one, at that point you're going to enter the trade. And this one was huge. I mean, we're talking H4 candles here. This was good for 120 pips, you guys. Again, these opportunities are going to be fewer and further in between, but when you catch them, and it's going to be money. You know what I'm saying? You get that divergence right there, it's going to be money. That's good money. All right, so, you know, same thing. I see another one right here, actually. We can go to our line graph again, make it a little easier to spot. So you see the 25 level right here was hit, okay? And then you have the RSI come back down right here and form another low. So we got, boom, price formed a low. On the RSI, you got a low and then a higher low, okay? Meanwhile, on your price, the market formed a low and then a lower low. This was a strong divergence right here, okay? Anytime the line is steeper, the steeper the line is, the stronger the divergence is. So we go back to this graph right here, and boom, as soon as you saw this candle close green, probably would have waited on the second one to kind of close above the red one. But once you saw the market moving in this direction off the divergence, you're able to jump into that trade. And the market moved that time pretty much straight up for about 130 pips. All right. So these are going to be great opportunities for you to see when there's divergence in the market, when you see that, you know, the trend is cooling off essentially. That's essentially what that means, that the market was moving in one direction and that move is starting to cool off. It's losing steam, it's losing strength for a bullish divergence. And if you see it going from, you know, from the high to the low on the RSI, that's called a bearish divergence. So this is a regular bullish divergence. This is a bullish divergence. The ones that we saw with the RSI at the top from the 75 level forming highs and lows, that was a bearish divergence. So this is a classical bullish divergence. The other examples that we showed for the sales were classical bearish divergence. All right. There's another type of divergence called hidden divergence. We're not really going to get into that on this video. This video is just going to be classical divergence. But that's going to be it for classical divergence, you guys. I hope that blessed you. I hope that gave you another tool to add to your arsenal for your trading. If you guys like this strategy, if you guys like this technique, like, subscribe, comment to the channel, drop a fire emoji down below, hit us with a thumbs up. Drop your Cash App down below this video. We will be doing another Cash App giveaway next week. So drop your Cash Apps down below this video. Again, like we always say, guys, let's trade together, win together, and grow together. Peace.